Here's your money briefing for Thursday, July 20th. I'm J.R. Whalen for the Wall Street Journal. Millions of high-earning Americans who make so-called catch-up contributions to their 401k accounts are in line to lose a popular tax deduction next year. WSJ retirement reporter Ann Tergesen joins us. So first of all, Ann, what is a catch-up contribution and what does it allow 401k account holders to do?
So a catch-up contribution is an extra contribution that people 50 and older are allowed to make to their 401ks. So the way it works is this year, the IRS has set a limit of $22,500 that anybody can contribute to a 401k. And for an employee, that's the maximum that you can contribute. But if you're 50 or older, you can actually contribute an extra $7,500. So somebody who's 50 or older can put in a total of $30,000 this year into their 401k, thanks to these catch-up contributions.
So how are the rules changing, and do they affect more than just people in their 50s?
No, the change in the rules affects people 50 and older who are making catch-up contributions to their 401k. What the new rule says is that if you are 50 and older and making catch-up contributions and you earn more than $145,000 in the prior year, then your catch-up contribution has to go into a Roth 401k. It can't go into a traditional 401k.
All right, let's just stop for a moment and do a little 401k 101. What is a Roth 401k and how does it differ from a traditional 401k?
Okay, so the way that the Roth 401k and the traditional 401k differ is all about tax treatment of your contributions and tax treatment of the money that you withdraw in retirement. For example, with a traditional 401k, you get a tax benefit up front. The money that you put in is not taxed in this current year that you contributed. Instead, with a traditional 401k, when you take the money out in retirement, you pay income tax then. A Roth 401k kind of reverses that, and the money that you put into a Roth 401k is taxed in the current year when you contribute it. But in retirement, the money can come out tax-free.
So why are these rules being changed?
So the reason why people who are making catch-up contributions, that's people who are 50 and older, who have incomes that are above $145,000, they are being kind of forced into putting those catch-ups into a Roth is because that generates income tax revenue right now. And Congress needed a way to pay for a retirement bill that passed last December, and that was one of the primary ways that they used to pay for it.
Will everyone pay more in taxes on their contributions under the new rules?
No. The only people who are going to be paying more in taxes than they would have otherwise are people who are 50 and older and are making catch-up contributions and earn more than $145,000 a year. Those people, if they had preferred or would have opted or been defaulted into a traditional 401k for those catch-ups, they would have gotten an upfront tax benefit that they will no longer get, and instead the money will be taxed this year.
Now, financial planners you spoke with suggest that everyone put money into a Roth 401k under the new rules. Why do they suggest that?
The general point that financial planners make these days is that it's good to have what they call tax diversification, by which they mean most people can benefit from having some money in a Roth 401k or a Roth IRA, which is, a similar type of account. So the idea being that when you're in retirement, people who have a lot of money in traditional 401ks, once they hit age 73, they have to start taking that money out. That's something that the IRS mandates. It's the law. And when they start taking that money out, they owe income tax. And so if you have been a big saver your whole life and you've put a lot of money into a traditional 401k, you are going to be pulling a lot of money out annually, and that could easily get you back into the same kind of tax bracket that you were in when you were working. So the idea being that if you have some money in a Roth, you can pull that money out tax-free, and in a year when you say you need extra money to do something, but by pulling that money out of your traditional account, it's going to push you into a higher tax bracket. Instead, you can take the money out of the Roth, You get that tax-free income. It doesn't push you into a higher tax bracket. It can be a very useful tool for tax planning in retirement.
And people could face some decision-making when it comes to estate planning or mapping out their retirement.
Right. So it can be a useful tax planning tool for people in retirement, but the Roth is a far better asset for your heirs to inherit than a traditional 401k is. The reason being that with a Roth, your heirs will inherit tax-free money. And often when people inherit money, they're often in their peak earnings years. Maybe their parents die and they're in their 50s, and they're earning at a level that puts them into a higher tax bracket. And then if they inherit a traditional 401k, they're going to be required to pull money out of that and pay taxes at the high rate that they're in their peak years. So in contrast, if that same person inherits a Roth, that's tax-free money, and they don't have to pay any income taxes, the same as with a traditional 401k, but it's tax-free, so it doesn't cause them to have to pay a huge amount more in taxes.
And all the money is theirs.
And all the money's theirs.
All right, that's Wall Street Journal retirement reporter Ann Tergesen. And that's your Money Briefing. I'm J.R. Whalen for the Wall Street Journal.